Okay, so we're going to start our meeting. Okay, so we're going to start our meeting. I had recorded a previous meeting. I haven't been able to, I didn't record, so I'm doing this again. Hopefully that was a good dress rehearsal. And it was great meeting all of you this week. It was great you guys did fine so far. Please contribute to the discussions from last week if you haven't done so already. This week we're going to be covering portfolio models. And I want you to download the spreadsheet. And how do you do that? You do it by, we're going to talk about expected returns and the mechanics behind portfolio calculations. We're going to determine monthly average returns, determine monthly standard deviations, compare the average of volatilities, and calculate risk rewards. Those are our objectives this week. Click on that spreadsheet, and you will get that. Okay? So you'll start out by looking at different scenarios. Determine the monthly average returns, standard deviation, which is a function of risk. Standard deviation tells us the dispersion of around the returns, right? We look at monthly standard deviations, and we could look at the risk-reward ratios for all stocks. So this is returns that we downloaded from the Yahoo spreadsheet. Now, one thing I want to be very clear about is, and I'm going to keep making mention, and I put it up on this week's work. Hold on. Okay, I put it up on this week's work, and I'm going to go up to here. Bear with me for a minute. A little tough with this thing. I gave you my, if you go to the objectives for this week, if you go to this week's learning module, you'll see that I added my YouTube channel. So on my YouTube channel, I really want you to pay attention to this because I edited it. It's in my playlist, and it's my Finance Academy.
Today we're going to look at equity.
I'm going to stop that for a minute. Hold on. And my Finance Academy. Hold on a minute. And my Finance Academy has a capital asset pricing model, which we're covering. Beta, it's how we measure the capital asset pricing model. It's how we measure the risk of a stock versus the overall market, which would be like the S&P 500. And there's a weighted average cost of capital calculator. So all of these things are in my Finance Academy. How would you find it? We're going to go to our class. And here's financial modeling. And here's week 2. Here's lesson content. And it's right at the bottom. I gave you a great visual on weighted average cost of capital. There's my Finance Academy playlist. There's my video. So that should really cover you on a lot of the stuff that you are going to need for this class, for this particular lesson module. Let's go back. Bear with me for a minute. So we're looking at stocks and appliance portfolio. We have the spreadsheet. And how do we download historical performance? Once again, go to my videos. I do one on that when I do the beta and the regression. But how you would do it practically is you would go to Yahoo Finance, stock, and we'll say Apple. And once I pick Apple, then I go to historical data and download the data. Once I come up with historical prices and apply it, then I could just hit download, and that'll download right into a spreadsheet. But they've done that for you here. So you've got a lot of the information ahead of time. And this is all of the returns. And to find a return, I find the average return, and I can annualize it by multiplying the monthly mean by 12, and the square root gives me the standard deviation. Calculate return, I divide new by old, and I subtract 1. And that gives me my log normal return. Why do we say log normal? Because it gives me, it's a return. We're not doing it log normal. That's just another concept. But it gives me my average return. So in this case, in Walmart, in April of 16, for that month, it was down 2%, then it was up 4%, down very small, up 8%. It gives you the monthly returns. Then it gives you the variance, and then the standard deviation, which is the dispersion of returns, which measures, which normalizes it, like on a percentage basis, how risky one thing is from another. I'd like to show you something while we're at it that would better illuminate, because the whole idea behind standard deviation is really important to understanding how we measure risk. Because what it tells me is if I have two averages, yes, that's great to understand that. But what I'm really trying to figure out, let me just close that for a minute.
We have zero growth, constant growth.
Okay, that's one of the other videos. I'm going to close that down for a minute. What I really am aiming for when I talk about these things is I'm trying to understand if I have two securities or two sets of shirt sizes or two heights of people, and they both look this, and I take enough of a sample, not two, but many samples. The sample should represent the population. How accurate is that? How much can I rely on that sample? That's standard deviation. Standard deviation tells me how much I can rely on a sample. So I love this video, and I show it to my classes when I try to explain it. I want you to see it. It's about the central limit theorem. And the central limit theorem gives us an idea as to how to measure risk versus return. So let's take a look at it.
Somewhere in the field, a brave ecologist is studying wild rabbits. He plans to record the weights of every single rabbit. If he follows this plan, he will notice that most of the rabbits are close to the average, and that there are some rabbits, but not many, that are much larger or much smaller than the average. The further from the average you get, the fewer animals there are. This particular bell-shaped curve is called a normal distribution. Sadly, he has to give up his experiment, for it will cost him a fortune in carrots to complete it. So, he changes the plan. Instead of measuring every rabbit in the whole group, he decides to measure rabbits in small groups, chosen at random from the whole group. He knows that each small group won't necessarily be perfectly representative of the whole group. So he measures many small groups and then compares the averages of each. He starts by weighing 5 rabbits at a time, and he finds that the distribution of the average is somewhat bell-shaped. Then he increases the sample size by weighing 20 rabbits at a time, and then 100 rabbits at a time. Surprisingly, as the sample size increases, the spread decreases. The distributions of average weights becomes more and more normal. What our brave ecologist has just demonstrated is the central limit theorem. The averages of samples have approximately normal distribution. If the sample size increases, this distribution of averages becomes more normal and narrower. What if the population distribution is not normal to begin with? For example, the distribution of dragon wingspan is known to be bimodal. If an even braver ecologist were to study wild dragons, and measure dragon wingspans, the distribution of the average wingspan would still be approximately normal. And again, the more dragons our brave ecologist could measure at a time, the closer the distribution of their average wingspans will be to a truly normal distribution. The distribution will also be narrower. So now we know that regardless of a true distribution, the central limit theorem shows that the average of values drawn from the distribution will always be approximately normal. Furthermore, the bigger the sample size, the narrower the distribution of average becomes. And the closer the mean of the sample gets to the true mean of the population. This is why sample size matters so much in any statistical analysis, whether it is a political poll or evaluation of a medical procedure. There is something very special about the normal distribution. Not only do many things we measure in biology follow a normal distribution, but it also crops up when we look at estimates of variables, even when the variables themselves don't have a normal distribution, as we saw with dragon wings. Because of this, we can use the normal distribution to test ideas about the world even when the underlying variables don't follow a normal distribution. My name is Pothikrit Bhattacharya.
Okay, so
This
that's a great video and a great representation. But I want to just do one other thing, and this is an example of it. And if I know my expected returns, right? If I know my expected returns, I can also get a view of how risky my security is. So if I have a security with a plus 24% rate of return, minus 0.12% rate of return, plus 0.20 rate of return, minus 0.10% return. What's my average return? This is all my scenarios. This is worst case. These are moderate cases. This is positive. Then I could attach probabilities to these. So I could say this is a 5% probability, a 20 and a 20. They have to equal 1. So if I made this 10 and this 10, that would be 20. And these two would have to be. The worst case is this is 4 different scenarios. Getting 24% would be a 24% probability. Getting a minus 12% would be a 25% probability. Getting that would be a 50% probability. And now I got 75, 85. This would have to be a 0.15%. They have to equal 1. And that's how I get an expected return. I multiply this times this, get that. And by doing this, these scenarios just kind of illuminates what they're trying to show you based on these probabilities. Okay? But remember, when I do expected return, I'm looking at historical returns, right? I'm looking at historical returns. And there's no guarantee that those returns or those predictions that I'm making will happen in the future. We know that the future holds many risks, like COVID, or hurricanes, or war, God forbid. All these things are possibilities we can't predict. But in the abstract, I can come up with some sort of expected return. And once I do the standard deviation of these returns, right? Once I figure out what my standard deviation is of these returns, and that's what they kind of standard deviation of these returns, I come up with a way to measure risk. So if 7.9% is my average return and based on a probability distribution, I know that my standard deviation is going to be 5.8%, 5.8%. So within, what does that do for me? It allows me to put this in a normal distribution. Once I put it in a normal distribution, I know within 66% of the time, I'm going to fall within one standard deviation. So I could say that 66% of the time, my samples should fall within one standard deviation, and with 95% of the time within two standard deviations, with 99% of the time within three standard deviations. So going back to this, add 5.8% or subtract 5.8% to get one standard deviation, add it twice to get two standard deviations, add it three times to get three standard deviations. So if I have two stocks with the same expected return, but one has a higher standard deviation than the other, that stock is going to have more risk. And that's really what you want to pull away from this. Okay? That's what you want to pull away from this. All right? And there's just more on what we did. We use the S&P 500 as a benchmark because the S&P 500 gives us an overall look at all the major stocks in a portfolio. And we find this, and if we want to annualize it, we just need to multiply the monthly average. The mean is the average by 12. We want to annualize the standard deviation. We multiply the monthly standard deviation by the square root of 12. So remember that little mathematical trick. To find the annualized mean, we multiply the monthly averages by 12. To annualize the standard deviation, we multiply the monthly standard deviation by 12. So you see that the volatility of a portfolio, 11.44%, is lower than the individual stock's volatility. And why is that? Why is it that the volatility of a portfolio is lower than the sum? Because it's not additive. Well, it's called the magic of covariance. It's the magic of covariance. So there's your expected return of two stocks, Cisco and Apple, which would have a much higher variance. Those standard deviations are much higher. But notice when I blend these stocks together, the standard deviation is lower. That's because in stock theory, when we blend more and more risks together, we have two types of risk. We have systematic risk and we have unsystematic risk in every stock. Systematic risk is the risks in the system. Unsystematic risk is the risk for each stock. So an unsystematic risk, say for instance, would be the risk that airline company, oil prices go for an airline company. That's an unsystematic risk, right? That just is indigenous or involves an airline. The same thing, an oil company that produces oil, because they make money when the oil prices go up. But if I buy both stocks, I blend my risks together. What benefits the oil company hurts the airline, but on the other hand, what helps the airline hurts the oil company. And I could buy, say, Coca-Cola, where people might be concerned about taking in too much sugar. I can blend that with a diabetes drug. And what portfolio theory tells us is, as I add on more stocks, probably about 40 or 50, I can eventually take out all my unsystematic risk. So I don't get paid for that. What I get paid for is my systematic risk. And systematic risks are the risks that we cannot hedge, the risk that COVID would show up, the risk that we, God forbid, get into a war, the risk that, something happens globally that we can't predict. And those are the risks that I'm concerned with. So as I blend more and more stocks, I get rid of my unsystematic risk and I keep my systematic risk. And that's the underpinning of the capital asset pricing, which you're going to learn more about now in this unit. So how do I show that mathematically? As I keep adding stocks, notice that my return varies with my portfolio standard deviation. My return varies with my portfolio standard deviation. So I have 60% in Cisco, I have 40% in Apple, and there's my expected return if I put 60 in Apple, 40 in Apple. But notice through this formula of covariance, when I take the square of the weight of one stock but times its variance. That little sigma means variance when I square it. Plus the weight of a second stock, plus that variance, plus 2 times the weight of both, times the covariance, times sigma, which is a lot of heavy math, I lower my overall standard deviation. It's a mathematical representation of what I just explained. As I blend different risks, my portfolio standard deviation goes down. That's the takeaway from this. Through covariance, I lower my overall risk of my portfolio, right? And there's, notice that my portfolio standard deviation goes down from the higher numbers up here. Look, I mean, no matter what weight I have, it's going to be higher than 24.92% because I have a 30 and a 25. But when I blend these risks together, mathematically, I have a lower standard deviation. And now I could create a spreadsheet where I keep varying the 2 different stocks in a 2-stock portfolio. So, and by the way, I should stop here and tell you that this week's word is table. This week's word to verify that you watched this video is table. So when I look at a 2-asset portfolio, I know the weight of Cisco, so by proxy, I know the weight of Apple, because if I have 5% of Cisco, then I have 95% of Apple. And notice as I keep varying my weights, my portfolio expected return varies with my level of standard deviation. In other words, for me to get more risk, I have to take on more. For me to get more return, I have to take on more risk. And Harry Markowitz, in his Nobel Prize-winning study, he combined these 2 stocks. Any 2 stocks, any 2 asset returns could be combined. And what you'll find mathematically using covariance, it's all going to look like this, or the efficient. What the efficient frontier tells me is that as I plot these stocks, I'm going to have a point on the line. I would never want this combination. Because this combination gives me lower returns with the same risk, where I can get higher returns with the same risk. Why would I take low? Well, no rational investor would want the same return with, this is risk, this is return. I would get lower risk with the same, I would get lower returns with the same risk. No, I want higher returns with the same risk. And somewhere along the line, if I'm a risk-averse investor, I'm going to want the lowest risk for the highest return, which would be right here. And if you use calculus, you can come up with this line. For those of you who are mathematically friendly or comfortable with math, you just use calculus to find this point. Then as I add risk, I get more return. As I add risk, I get more return. But it's a concave line. And the reason why the efficient frontier looks like this is because I get smaller amounts of return for larger amounts of risk. Notice when I move from 29 to 30, which is a full 1%, I'm getting less than 1% return. And mathematically, you're going to get a lower return for the amount of risk you're taking. So that's why we call it the efficient frontier, because here I get my minimum variance risk versus return, which would be this yellow line. It gives me the highest level of return for the lowest level of risk. But if I want more return, maybe I'm an investor who wants more return. I want 12%. Then I got to jump from 25% risk standard deviation to 30%, which is not really a great trade-off because I go from 24.575 to 30%, but I'm adding on all this standard deviation. I go from 9.63% to 12%, but I'm adding a lot more standard deviation, a lot more risk. But that's why markets sometimes get overvalued. In my experience as a stock trader, and I have many years of it, sometimes investors, in the desire to get more return on their portfolio, will add too much risk. That gives them a worse rate of return. And that's why when we say markets are overvalued, what we're really saying in the mathematical sense is investors are reaching for return, adding on a lot more deviation to get a little more. So you understand, like right now, the markets do concern me because I think investors are getting too aggressive. They're getting too aggressive. That's just my opinion, obviously. Okay. The spreadsheet gives you, this is what we just went over. The minimum variance portfolio was the highest mathematical rate of return given the lowest level of risk, which is measured by standard deviation. And the spreadsheet is terrific because it shows you how you can, instead of you doing calculus, you just use the solver function. So you can play with this and see how they did it. And it's a great thing to store on your computer Because later on, if you're going to get a job in finance, this is the kind of stuff they're going to ask you to work. Because why would they ask you? Because money managers might use the efficient frontier to see with any portfolio that they're looking for a client, where the best place for the client is, depending on what they want in terms of return. And they can explain to them, you want more return, I'm giving you more risk. Capital asset pricing model is something that we need to understand, because this now relates, now we can bring it back to the capital asset pricing model, which is a way for us to take that systematic risk and unsystematic risk and put it into an equation. And this was done by these three greats of finance, Trainer, Sharp, and Linter. These were people who studied this, and they said, well, a portfolio should equal the risk-free rate. And they introduced the risk-free rate, which is money you could just put into the treasury market. When we talk about the risk-free rate, it's really just buying treasury securities. Because every investor has the opportunity to either put their money in the market or put their money into something that's safe and risk-free, which we would consider the risk-free rate. Which we would consider the risk-free rate. So the risk-free rate plus the beta on the market times the risk of the market, which is the S&P 500, minus the risk-free rate, is the capital asset pricing model. Once again, I urge you to go to my Finance Academy channel, which I gave you in this week's work, because that's going to give you, I do a whole thing on finding beta and finding this and understanding the capital asset pricing model. It's the risk-free rate plus the beta times the risk of the market, and then we take out the risk-free rate. And that gives us a view of the risk of a stock. So when we combine the risk of a stock plus the risk on the debt, those two together give us the weighted average cost of capital. So we know what the hurdle rate is for an investor who buys a stock, what rate they're expecting to get from us. Because we can only fund our company with either investors, which is stock, or by borrowing money, which is debt. The combination of both is going to give me the weighted average cost. So we got the risk-free rate plus the beta, which is the regression of the market versus the risk-free rate. What it really tells me is when I compare the market, which is the S&P 500, to my stock return, how much does my stock return move with the market? Right? How much does my stock return move with the market? Right? If I have a company like Coca-Cola, right? This is Coca-Cola, and hold on, and this is the market. Coca-Cola might only move like this, because people would say, well, when the market's up, there's only so much Coca-Cola could go up, and when the market's down, people are still going to drink this stuff. So Coca-Cola's beta is like half of the market. Coca-Cola moves about one half to the market. But a stock like Tesla, I'm going to give you a much wider line, moves much more dramatically with the market. And the reason why that happens is because Tesla is much riskier. In a bad market, people aren't going to want to go near that stock or want to buy those, whatever they're selling. But in a good market, they may feel people have money in their pocket. So they may be 1.5 times the market. This particular stock has a beta of 0.8, which means it moves in an 80% velocity. So 1.5 times 80% times the risk premium, and the risk premium being the money you make in the market minus the risk-free rate. It's the extra return you get. Means the return on this stock is 6.3%. And that's the capital asset pricing model. Again, how could you, I don't want to go, make this too long, but you can find it by going right here and getting the equation. And we can plot this, a visual representation of beta, which is sort of like the same thing we did before with standard deviation, would be plotted here on the x-axis, and return here would be on the y-axis. At 0, we just get the risk-free rate, and as we increase risk, or beta, we get more return. We get more return. Notice it's an upward sloping curve, and it should be, because return should increase with risk. The capital, when I apply it to the CML, go back, which represents the different combinations of the market portfolio and the risk-free rate. Now I'm looking at the entire portfolio based on how the whole market would look. So let me go back. Notice that the CML starts with different standard deviations versus different returns. And we plot it against the efficient frontier. The minimum variance portfolio still stays the same, but compare the entire market, we start to see where it's tangent to this efficient frontier. Still, if I want to take the least risk for the most return, I'm going to try to combine the 9.63% return, which is right here, which is the lowest risk. As I want to take more risk, I have to move up this CML. The CML represents the risk premium of efficient portfolios as a function of portfolio standard deviation. The Sharpe ratio is a way for us to measure how much return my stock has given me minus the risk-free rate over its standard deviation. It's just another way, and this was developed by Sharpe, who was part of the capital asset pricing model, Sharpe, Trainer, and Linter. This was a way for us to look at if my security is earning 12% and the risk-free rate is 2%, that means I'm earning a risk premium of 10%, right? It means I'm earning a risk premium of 10%, 12 minus 2. If my standard deviation is 0.5, right, then 10 over 0.5 is 2. But if my standard deviation is only 0.1, then 10 over 0.1 is 100. Higher numbers in the Sharpe ratio mean I'm getting more return for the risk I'm taking. So I want to see a higher Sharpe ratio. And the beautiful thing that Rasmussen does for you is it gives you a good representation. So what I want to do is I want the highest return for the lowest amount of risk. And that's represented here. And then what you'll do as a knowledge check is that you'll go to the last thing and you'll start to work out. Download Disney's stock prices, download the S&P 500, download Disney's return. Just do the same thing and follow all of the examples here. And what it'll show you in the end is the risk of Disney versus the risk of the overall market. And then you'll take a quiz at the end of your learning objective. And I'll grade it. We'll grade that along with your discussion. But this gives you a good representation of how we measure relative risk. And once again, I want to go over standard deviation again because it's so important. I want to do two things here. I want to show you one more video, which I think is pretty cool. You know, now don't forget you have my own videos, but I'm going to give you another video that I like. Let's see if I can find it. Take a look at this one.
The essence of risk-return trade-off is embodied in the common phrase, no risk, no reward. Risk is usually defined as the chance that an investment earns less than what is expected. The greater the actual earnings deviate from the expected earnings, the riskier the asset is said to be. Each investor has their own risk tolerance. Some investors are very conservative and thus not willing to accept much risk in their investments. Other investors are very risk tolerant and can stomach a high level of risk, even to the point of losing their entire investment. Return varies with the amount of risk an investor is willing to assume. Typically, the higher the risk, the higher the return. However, note that higher return means potential return, not guaranteed return. A loss is just as possible and can be just as big as the potential gain. Thus, investors try to strike a trade-off between the two so that they can achieve the highest level of return for the lowest level of acceptable risk. United States government securities are considered the lowest risk investments because there is virtually no chance of default. The interest rate on these securities is often referred to as the risk-free rate. Thus, any return percentage above the risk-free rate is considered a risk premium, which is what the investor is willing to potentially be paid for accepting some risk.
That's really good. I like that. And it also shows you one more I want you to see because I think this helps. And then again, go to my videos. Please go to my videos because you don't need to do that for your problems, but it will help you to understand them. How the capital asset pricing model works. Since we do have a limited time here, we don't want to.
Or the square root of the variance is a measure applied to the annual rate of return of an investment to measure the investment's volatility. Every time you buy a stock or a mutual fund, you're weighing its expected return against its inherent risk. The past gains or losses of an investment are fairly easy to look up, but gauging risk is a little trickier. Applying the standard deviation formula will show how much an investment's price has gone up or down in the past, and therefore helps in evaluating future outcomes. Take, for example, a security, where we analyze 5 periods of the following stock returns. 2% in January, 7.5% in February, 1% in the next month, 6%, and 1.5% finally in May. To find a standard deviation for a security, find the average historical return, which is 3.6%, and subtract the returns from each month. Square them and find the sum. Next, we divide that sum by the number of observations minus 1. In this case, it would be 4, leaving us with the result of 8.675. Taking the square root of that number, we are left with a standard deviation of 2.9. The calculation can be particularly helpful when looking at similar investments in the same asset class. If one investment has a higher standard deviation than the other, that investment is more volatile. Note that past volatility, or lack thereof, doesn't perfectly predict future returns. A stock that has been consistent for months or even years may suddenly experience sharp fluctuations.
That last point is really important because, yes, stocks that have been low volatile for a long time might start to distribute different volatilities. We saw that now. Companies that look solid once COVID hit are not solid. I want to give you one more example of standard deviation because it's so important in terms of understanding risk. So I have two companies, and these are the earnings from the business. So they make 25, 50, and one, right? Another 25. That's the distribution of earnings. I'm sorry. 25, hold on, 50, 25, and 100. So the average earnings over these four quarters, you can find it by putting an average. You can also find it from the formula bar. If you're not familiar with Excel, you will be by the end of this class. Is 50. Total would be 200. Now that's company A. Company B has average earnings of 25, 75, another 75, 25. And their average is also 50. So by looking at both companies, I'm saying, well, the average earnings are the same. We have the same kind of company. But that's not what tells us whether it's risky or not. What demonstrates risk is the standard deviation from this mean. Mean means average. And how do I calculate that? Well, I'm going to do it this way to make it a little easy. To show you another way to do it is actually go up to your recently used. I use standard deviation. You're going to get this dialog box. Hand through your observations. And I'm going to get a standard deviation of 35. That means within 65% of the time, my earnings will be 50 plus 35, 50 minus 35, within 95% of the time. 50 plus 2 times 35 plus 50 minus 2 times 35. Let's see what the number is for this company. 28. This is obviously the lower risk company because my deviations from my average is lower risk. My deviations of my average is lower risk because within 65% of the time, I'm going to be plus 78.86 or minus 50 minus 28, which is 22. or I'm going to get a bigger dispersion here. And that's why standard deviation allows us to normalize risk and understand the risk of my stock. I hear, without understanding math and not taking this class, I would think it was the same average. Maybe those are two basketball players, and that's their averages. But I know that one's more predictable than the other because because of the central limit theorem tells me that I have a lower standard deviation. Okay, we're going to wrap this up here because we're going on 40 minutes and I don't want to overload you. But I do want to tell you this. Contact me if any of this doesn't make sense, or if the work that you have to do this week it doesn't isn't clear, because I will absolutely go over that with you. Go do the discussions, download the assignment, download this spreadsheet, do the knowledge check, answer the questions, and you will be fine in terms of modeling. And then we will go over next week what kind of answers you receive from there. It's been great working with you. It was great to hear from both of you, and you know where to reach me anytime. Just give me a shout out on the text, and I'll get right back. All right. Have a great week.